Today's lecture will be on Chapter 16, Investing in Mutual Funds. Let me get this out of the way right now. I despise mutual funds, and I despise them for two reasons. One, the fees that many mutual funds charge, and two, the lack of control that you have to individually invest. But let's talk about them so you are knowledgeable about them. But many people invest in mutual funds. You can see that 100 million individuals own mutual funds, and they have grown exponentially, as you can see here. So what is a mutual fund? Mutual fund is a type of investment pool that pools the money of many investors together as shareholders to invest in a variety of securities. It's easy to invest. Oftentimes it is diversified, and you do have quote-unquote professional management. Let's talk about three different characteristics of mutual funds. So let's first talk about a closed-end fund. These are not that popular or relevant today. As you can see, there are just over 500 investment companies that offer closed-end mutual funds. These are funds that are issued by a mutual fund investment company only once when the fund is organized. So the mutual fund company sells the mutual fund shares, they don't have to buy them back. So after the original shares are sold by the mutual fund company, you can purchase shares only from another investor who owns them and are willing to sell. So closed-end mutual funds trade just like stocks on an exchange, and they go up and down or fluctuate throughout the day. I would much rather own an ETF. This is something I do want you to own. An ETF is an acronym for an exchange-traded fund. Usually these invest in stocks or other securities contained in either specific stocks, such as financial stocks, or an index. Unlike a mutual fund, exchange-traded funds are not actively managed by a portfolio manager, and thus the fees are very low. Usually it can be as low as less than 1/10 of 1% per year, which is low. And just like a closed-ended mutual fund, they are traded actively throughout the day and will fluctuate in value. Most mutual funds are what's known as open-ended mutual funds. As you can see, there are 9,000 investment mutual fund companies that offer open-ended funds. Unlike a closed-ended fund, with an open-ended mutual fund, shares are issued and redeemed by the investment company at the request of investors. So it doesn't actively trade on an exchange. Thus, it does not fluctuate up and down in price per day. In fact, there's only one price per day, and that's known as the net asset value. So investors can buy and sell shares from the mutual fund company at what's known as NAV, or net asset value. Net asset value, as the slide shows out, is a simple formula. You'll need to know this for your exam. The numerator is the value of the fund's portfolio, or its assets, minus its liabilities. Think of balance sheet from earlier. So assets minus liabilities in the numerator. The denominator is the number of shares outstanding that the mutual fund is issued. That will give you its value of each share. And that's the price that the mutual fund company will sell it or buy it back from you at the end of each day. So an example of net asset value can be found on this slide here. American Frontiers Mutual Fund has a market value of $655 million, and it has liabilities of $5 million, and there are 30 million shares. So it would be 655 minus 5 million in the numerator divided by 30 million in the denominator to get you an average share price or net asset value of $21.67. Now, one of the reasons why I despise mutual funds is because of the fees that they charge. There are different types of fees that you're going to come to realize. Oftentimes people think of mutual funds as either load or no load, and that's correct, but just because there's a no load doesn't mean there aren't fees. There definitely are fees on a load fund or what's called Class A shares, mutual fund shares. With a load fund, the investor pays a commission each time they purchase shares. The average commission can be between 3 and 5%. Sometimes it's as up as 8.5%. So you can see this can get very expensive right away. Now, a no-load fund, which I would always recommend if you had to buy one, charges no sales charge up front. But just because, as you're going to find out, a mutual fund is no load doesn't mean there aren't fees. Remember, a load is fund, or a Class A fund is when the commission or sales charge is upon purchase. A type of no load fund is a contingent deferred sales load. Here the load is not up front, but it's on the back end when you sell it. These are called Class B shares. So it's not charged when you purchase, but when you withdraw the funds. The good news is that although the fees range from 1 to 5%, the deferred charge or the back end load charge will decline until there's no withdrawal charge if you own the shares in the fund more than 5 years. So the longer you own it, the lower the amount of the deferred sales load until after 5 years it's eliminated altogether. Those are Class B types of mutual shares. Class C types of mutual shares are what's called 12b1 fees. These are fees that are charged on Class C shares, which have either no sales load charge up front or no contingent deferred sales on the back end. So, but they'll usually charge a higher distribution fee. In addition, whether your mutual fund is Class A, Class B, or Class C, most, if not all, mutual funds will charge an annual management fee of between 0.5 and 2% of the fund's assets per year. All of these fees added up are known as its expense ratio, and that consists of all the different management fees and 12b1 fees and any additional operating costs. And they have to now, the mutual fund company has to list all these expense ratio fees in what's known as its prospectus, which is usually some sort of summary or statement of the mutual fund company. So this is a great slide of the typical fees associated with mutual funds investments. So your mutual fund shares will either be Class A, Class B, or Class C. They can't be both A and B or A and C. The next several slides, we're going to look at different types of mutual funds. So some mutual funds are invested in stocks, and you can see here the different types of mutual funds for stocks. In addition, mutual funds can be invested in bond funds. In the following 3 slides, we'll look at different bond funds, which I'm going to go through very quickly. But besides stock and bond funds, there are other types of sort of exotic mutual funds, as you can see here. Different asset allocation funds or balanced funds of both in stocks and bonds. Fund of mutual funds. Boy, that sounds like a lot of fees. Even a family of funds. Boy, that just sounds very happy. All of them have fees, I can guarantee you. Now, I would tell you never to put money into a mutual fund. Sometimes you have to put money into a mutual fund. So for instance, if you are putting money into not an individual retirement account, an IRA, not an IRA, but an employer managed retirement account, On the private side, it's a 401k, or on the public side, it's a 403b or 457. You are required to put money into a mutual fund. So when you have to put money into a mutual fund because you're putting money into an employer-sponsored retirement account, you need to evaluate mutual funds. And so the first ones you want to look at is managed versus index funds. Managed funds will have a higher fee. Index funds will have a lower fee because they just follow an index like the S&P 500 or the NASDAQ 100 or the Russell 2000. Thus will have lower expenses. Pay particular attention to the top bullet point. A majority of these managed funds have failed to outperform the index of the S&P 500 over a long period of time. So why pay someone who's going to give you worse performance than just following it through an index fund? As you can see, these index funds have much lower ratios. In fact, use an ETF. It doesn't have to be managed. Remember, I told you a lot of those fees are less than 1/10 of 1%. Speaking of research, where can you do research? Well, obviously you can do research on the internet. Morningstar is a great website that tracks mutual fund performance. You can pay for an advisory service, that's fine. You can also go to each individual mutual fund to get what's known as the prospectus as well as its annual report. Again, a prospectus is a required disclosure of the mutual fund company of its fees and how it decides to allocate money towards investments. The mutual fund company is also required to provide an annual report that details its financial information. You can go to newspapers such as the Wall Street Journal or financial publications such as Kiplinger's or Barron's, etc. So again, where do you find mutual funds? It will be part of your 401 or 401k or 403b. Those are employer types, which you're required to put in there. You can also put it into your IRA, although I would recommend you don't put it into your IRA because you have more choice on how you individually want to manage your retirement account. Hence, it's called an IRA. It can be in a regular brokerage account. How do shareholders receive a return? Well, it can be in three ways. Well, the first way is through dividends. So again, just like stocks pay a dividend, well, mutual funds are invested in stocks or other types of securities that pay a dividend. You can receive money that way. That's taxed as regular income. The second way that a shareholder of a mutual fund company can receive a return is on a capital gain distributions. So that's when the mutual fund company sells the securities that are located within the fund's portfolio. That's generally paid once a year. This is not taxed as regular income, but it's taxed usually as long-term capital gains. The final way that you can get as an investor can get a return is through what's called regular capital gains, is when you sell shares of the mutual fund company greater than what you paid for it. If you own the mutual fund for less than a year, it'll be a short-term capital gain. If you own the mutual fund for longer than a year, that's a long-term capital gain. You want to be careful of the turnover ratio because the turnover ratio can obviously lead to more capital gains that you'll be responsible for. That's when the managers of the mutual fund company has been churning or been buying or selling different underlying shares within the mutual fund during a 12-month period. Again, here are the various purchase options. Again, you can purchase a closed-end fund or ETF through a brokerage firm. You can purchase open-ended mutual funds right from the mutual fund company. And again, withdrawal options, closed-end mutual funds or ETFs can be sold over a stock exchange. Whereas again, the open-ended mutual fund, you can sell back to the mutual fund company. This concludes our lecture on Chapter 16. investing in mutual funds. Again, never do it unless you absolutely have to.